good morning to all of you. Welcome back. So Monday morning, I'm happy to meet all of you. We have seen in the corporate valuation 4 different methods of corporate valuation. We have seen how the company is valued based on net asset value. That is called balance sheet method. So based on balance sheet, how the company can be valued. Then we looked at the balance sheet method itself, how the assets are not recorded at the present market value. All these assets have been recorded at historical value, and how it can be recorded at the market value, and how we can calculate the replacement value that we have seen. And then we looked at stock and debt approach, the second approach. We looked at the value of market shares and the value of debt, add both, and then that is called the value of a company. Then third method, we looked at the last lecture, we looked at the direct comparison approach, wherein the company looks into the various macroeconomic indicators, and then company should look at the various industry indicators. Then the company should look at the company indicators, and the company need to choose the comparable companies, that's what, of the same industry, of the same size, of the same asset value. The company need to choose the comparable companies, and the company need to choose the appraiser, or the appraiser who is appraising the company has to choose the financial variable, based on which financial variable this has to be, the company has to be valued. So the financial variable need to be chosen. After valuing after getting at the financial variables, the company needs to choose the way in which it can be computed. The company need to calculate all the financial variables value, and then based on the value of the chosen financial variable, the company need to compute the value of the subject company. The appraiser has to value the subject company. That we have seen, and we looked at the case study. And today we look at the fourth important method called discounted cash flow method. That is discounted cash flow method. That is, we call it DCF, discounted cash flow method. Fourth one, DCF method, discounted cash flow method. As we have seen, discounting means the company needs to calculate its present value. It's called discounting. Discounting means finding the present value. Compounding means finding the future value. Cash flow, the previous lecture we have seen, we have looked at what is cash flow, because profit is not equal to cash flow. Whatever profit the company calculates is not equivalent to cash flow, because when we calculate profit, we add certain non-cash items, and we add expenses which are not related to business. That we call it non-operating expenses. So these non-operating expenses, these non-cash items are recorded in profit and loss account, which will decrease a profit. And there are certain incomes which are not related to business. For example, dividend received, interest received. These are all incomes which are not related to business. We call it non-business income. Income for the company is sales. For income is sales. Whereas for a banking service, for a banking company, interest received is a business income. Business income means from the sale of its own services, from the sale of its own goods. That is called the business income. Any income that they receive other than the business activity, it is not called as the business income. See, for example, banking companies, interest income is the business income, whereas the manufacturing company, interest income is not a business income, it is a non-business income. So it depends on the business activity, what type of activity the company deals with. So interest income for a manufacturing company or dividend received, they are not non-operating incomes. So these incomes enhance or increase the profit. So those incomes need to be deducted to get the cash flow. So profit and loss account records non-operating expenses like expenses which are not related to business. Example, loss on sale of assets. So when we sell any assets, we sell any machinery, we receive, sometimes we incur a loss or sometimes we get a gain. So the gain on sale of assets or loss on sale of assets, that is not called the business income, or we cannot say the loss on sale of asset is not a business expenditure. So those expenditure or those incomes need to be adjusted. So to get the cash flow, these non-operating expenses or non-operating incomes, non-cash items that we have discussed earlier as a depreciation, or all these items need to be adjusted to get the cash flow. So the first thing under this method, the first step is to compute the cash flow. The first step is to compute the cash flow. Step one is computation of the cash flow. So step one is, from the given case study, we need to calculate the cash flow. Then step two is the company needs to calculate the present value. The present value of cash flow. That's what we call it, is a discounted cash flow. Discounting means finding the present value. So the company needs to find out the present value of its cash flow. How to get the present value of cash flow? Company should know its cost of capital. What is its cost of capital? So cash flow is at what rate of return? At what rate of return the company needs to calculate the cash flow? The rate of return here is the cost of capital. So the company needs to find out its weighted average cost of capital. So the second step is computation of weighted average cost of capital. I repeat, cost of capital is the rate of return expected by the investor. Cost of capital is the rate of return expected by the investor. As a bank is giving the loan to the company, and when the company is receiving the loan, the company needs to pay back its interest payment. The company needs to pay back its interest payment. So if the company doesn't pay the interest payment, the company, the company reputation is at stake. So what the company should do? The company should invest that loan amount in the projects where the company should earn the minimum rate of return. So for example, the company has to pay 9% interest to the bank. So the company should earn minimum 9% from that project. Company is receiving, say, 10 crore. So this 10 crore cannot be kept idle. So this 10 crore need to be invested in a project where it should earn minimum 9%. So that the company can earn the 9%, the company can pay the interest. The company earns 13%, then the company gets a profit of 4%. So 9% interest and 4% the company gets extra. So the minimum the company should earn 9%. So the minimum rate of return expected by the investor. Here the investor is a bank. Bank is investing in a company in terms of loan, investing in a project. So that is called the cost of capital. So the cost of capital is the minimum rate of return expected by the investor. It's also known as the hurdle rate. Hurdle rate, meaning to say the minimum, if the company could not earn that minimum rate of return, then the reputation of the company or goodwill of the company is at stake. It could not earn, so the company needs to borrow more. The company needs to borrow more to pay the interest payment, because interest payment is the mandatory payment on the part of a company. So here two types of funds that we have seen, source of funds, that is the debt funds and equity funds. So we need to get the cost of debt and cost of equity. So cost of debt has got its own advantage, because cost of debt has got tax advantage. The company pays interest, then the company pays tax. The more the company pays its interest, the company pays less tax, because interest is the taxable expenditure on the part of a company. The company can deduct its interest before the company pays its tax. So the company has got a tax advantage. The more the company pays interest, the less the company pays tax. So how to calculate weighted average cost of capital? That is KD into 1 minus T. KD into 1 minus T. That will give us the cost of debt, because tax advantage is there, plus into WD, that is the weight of the debt, in the weight of the debt, then KE into WE, because cost of equity, dividend is paid after the company pays tax. The dividend is paid after the company pays its tax. So KE into WE. So this is what we calculate the weighted average cost of capital. So once we get the weighted average cost of capital, calculate the present value of the cash flow. Now, here there are two types of model that we talk about. Discounted cash flow approach has got two models. One is the two-stage model. Second one is three-stage model. Two-stage model and three-stage model. So two-stage model, company starts today, then the company starts growing, company starts moving forward. Then at particular point of time, the company gets its maturity, then it starts falling. Then it gets stabilizes. Okay, so the company is growing at a certain rate. The company is going at a certain rate of return, certain rate of growth. Then the company gets stabilizes. There are two stages. One is the company is growing at certain rate of growth rate, and then the company gets stabilized. There are two stages. One is company is growing, then company gets stabilizes. So here, the growth period is not definite period. Growth period is not definite. It is not an indefinite period, it's a definite period. So say the company is growing, say at the rate of 20% for 5 years. Then the company, after 5 years, the 6th year onwards, the company is growing at 6% or 7% forever. So when will the company be closed? It is a perpetual in nature, it will not be closed. So we'll have to calculate the present value of cash flow for the first stage, that is during the growth period, and then the company needs to calculate the present value for the rest of the period. That means rest of the period means for how many years we need to calculate. That it is forever. So we need to calculate the continuing value. Because it's a perpetual nature, so we need to calculate the perpetual value or continuing value. So first stage, so step 3 we need to calculate. Step 3 we need to calculate the present value of cash flow during the stage 1. The present value of cash flow during the stage 1, that is for definite period of time. Definite period of time the company is growing. So present value of cash flow during stage 1, that is growth period. During the growth period, plus present value of cash flow for the rest of the period, stage 2. That is after, the company is growing, the company is having the constant growth rate. So what is its value? That is what we call it the present value of continuing value. continuing value. That is called perpetual value. So if you add both, so that will give us the value of a company. So how do we get that present value of cash flow during stage 1? That is cash flow, FCF of the first period divided by 1 plus R power 1. 1 plus R power 1, that is the stage 1, period, first year. Then FCF 2 divided by 1 plus R power 2. FCF 3 divided by 1 plus R plus 3. If it is for 5 years, so we need to calculate for 5 years, plus the present value of continuing value. Present value of continuing value or perpetual value. That is the present value of, for example, T plus 1, that is 5 years means the 6th year period, divided by WCC minus G. WCC minus G, that is weighted average cost of capital minus G. It's a growth rate into, we need to calculate the present value of the continuing value, that is 1 plus R power T. So that will give us the value of the company. I repeat. Dear students, it's a very important method that we are talking about. The method is based on the present value of the cash flow, the discounted cash flow method. The discounted cash flow method has got two models. One is two-stage model, another one is three-stage model. Two-stage model wherein the company is growing at a constant rate of growth, for a definite period. Then thereafter, the company is growing constantly for indefinite period. So constant growth rate for definite period, and second stage is constant growth rate for indefinite period. So we need to calculate the present, cash flow for during the first stage and cash flow for the second stage. So cash flow, as per the given information, as per the case study, we need to calculate the cash flow. So we need to get to the profit before interest and tax. So here interest is not taken into account. So profit before interest and tax, we need to calculate tax minus tax, and then we need to calculate changes in capital expenditure, and then we need to calculate changes in working capital. So that will give us a cash flow. So after finding out the cash flow, we need to get the cost of capital. So we need to get the present value of cash flow. So at what rate the present value need to be calculated? At the rate of cost of capital. So we need to calculate cost of debt and cost of equity. So how do we get the cost of debt? KD into 1 minus T into WD plus KE into WE. So that will give us the weighted average cost of capital. Then calculate the present value of cash flow. Present value of cash flow we need to calculate. So how do we get that? So cash flow divide by 1 plus R power 1, plus if it is for 5 years, then cash flow of the second year divide by 1 plus R power 2. Then if it is for third year, cash flow of the third year divide by 1 plus R plus 3. And if it is the fourth year, cash flow of the fourth year divide by 1 plus R power 4. And fifth year, cash flow of the fifth year divide by 1 plus R plus 5. So that will give us the present value of cash flow during the growth for stage 1. Stage 1, there is a definite period of growth. Plus, the company is growing at a constant growth rate forever, indefinite. So we need to calculate the present value of continuing value, or we call it perpetual value. So how do we get that? The 6th year cash flow, divide by WCC minus G. WCC means the cost of capital during the second stage, minus G, there's a growth rate of the second stage, and then divide by 1 plus R power T. So that will give us the present value of the perpetual value. Add both stage 1 and stage 2, that will give us the value of the company. So any clarification before we proceed for the case study? Case study is there already in the LMS. You can download and then we can share. Anybody who has got any doubt to be clarified?
Sir, can you just explain that equation, sir? Step 3.
Step 3. Step 3 is, so for example, if it is for 5 years. If it is for 5 years, the definite growth rate. Definite growth is for 5 years. Cash flow of the first year, that is FCF1 divided by 1 plus R power 1 plus FCF2, cash flow of the second year divided by 1 plus R power 2 plus third year cash flow 1 plus FCF of 3, cash flow of the third year divided by 1 plus R power 3. Fourth year plus cash flow of the fourth year divided by 1 plus R power 4, and fifth year cash flow divided by 1 plus R power 5. So that will give us the present value of the first stage, wherein the company is growing at the constant rate of, constantly the company is growing for a definite period of time. Plus the company is growing forever. The company is not, immediately the growth rate is falling, the company is not closed. The company is growing, the company is moving forward. So we need to get the continuing value, or we call it as the perpetual value. So how do we get that? 6th year cash flow. 6th year cash flow divided by WCC, that is the weighted average cost of capital of the second stage period. So because there are 2 stages here, so we need to calculate cost of capital for the stage 1, cost of capital for the stage 2. So stage 2 WCC minus G. G is growth rate of the second stage. Growth rate of the second stage. Divide by 1 plus R power T. That is the present value we need to calculate. If it is for 5 years, so 1 plus R power 5. Any clarification? Anybody? Any doubts? Anybody? Shall we proceed with the case study? Shall we proceed with the case study? This is the case study that you can expect for your section D case study for your examination, because these are all the case studies that can be asked for the examination point of view. Anything to be asked? So the case will be, it's a little lengthy case. It will be a lengthy case. You'll be given the proper information regarding sales, revenue, capital expenditure, depreciation, working capital. All this information will be given. We need to get the cash flow first. We need to get the cash flow first. That's what very important. Then we need to compute the WCC for stage 1, WCC for stage 2. So we will be given cost of debt, we will be given tax rate, we will be given cost of equity. To get the cost of equity, we need to calculate cost of equity based on CAPM model. I don't know how many of you remember CAPM model. Anybody was remember CAPM model? SML equation?
Yes, sir.
Yeah. What is that? SML equation? SML equation? Anybody? RF plus beta into RM minus RF. Remember? SML? Based on SML?
Yes, sir.
Yeah. Risk-free rate of return plus beta of the stock into market return minus RF. So RM minus RF, it's known as market risk premium. Market risk premium. So we take extra risk. So what is the extra premium the company gets? That's called RM minus RF. So RF will be given, beta will be given, MRP will be given, or we will be given RM. So we need to get the cost of equity. Then multiply with the cost of, multiply with the weights, get the cost of equity, get the weighted average cost of capital during the stage 1, weighted average cost of capital for the stage 2. Stage 2 we need to calculate. Then calculate the present value of cash flow for during the stage 1, present value of continuing value, add both. So that will give us the value of a company. It's the most accepted method. As all of us know, the retail Raja. Who is the retail Raja? Who is known as retail Raja in our country? Retail king? Hello? Who is considered as retail king in our country? Hello? Hello? Anybody? Deepak? Who is known as retail Raja? Retail king?
I don't know, sir.
Oh, very good. Who told? Who said? Gayatri. So Gayatri is given 1 mark. Gayatri is given 1 mark. Okay. So you have to, you got, I think earlier is the first time, no? You are answering? First time you are answering, no, Gayatri? Correct? Yeah, okay. So remaining 4 marks you have to get. Okay. So you need to get the remaining 4 marks. Gayatri is 303169.
Founder of Big Bazaar, sir.
Which one? Hello?
He is the founder of Big Bazaar.
Yeah, that we know, but that's what I asked her. I didn't ask the founder of Big Bazaar. I asked who is a retail king. Okay?
Kishore Biyani.
That she said. She said, so she is given 1 mark. Okay? So next time you try, my dear. Kevin, you try next time.
Connectivity problem, sir.
Which one? Okay. So 3-1.
Connectivity, sir.
31369. Gayatri got 1 mark. Gayatri got 1 mark. Okay. So, I mean, during this pandemic, he could not. So, all of you know that, no? The entire Big Bazaar has been sold. Sold to whom?
Amazon.
Hello?
Amazon, sir.
Amazon.
Reliance, sir. Reliance.
Reliance. What's the deal value? What is the value of the deal? Anybody? Exactly. Because a cash deal. It's a cash deal.
Somewhere around 24 crores.
No. I want exact figure. Exact figure. To get 1 mark. To get 1 mark.
24%.
No.
24,700.
No. No. Now don't search. No mark. Now by the time you can search and tell me. No. Now don't search. Now you can search and tell me now. So the time is over. Time is over. Yeah. Time is over. So nobody has told the exact value. 27,637 crore. Cash deal, complete cash. He has given, Ambani has given complete cash, Mukesh has given complete cash. During this period, it was doing very well. During this period, 9 months, all these buildings are, as all of you know, it is a rented building. No sales, but he has to, the operating cost, fixed cost remains same. He has to pay the rent, he has to pay, the stocks are on, could not be sold. So huge amount of debt he borrowed, he could not sustain, and then it has been sold. And next 15, the deal is not only the cash deal, the deal between Kishore Biyani and Mukesh Ambani is that Kishore Biyani should not start retail business for next 15 years. So next 15 years, he should not start any kind of retail business in India. So that is a deal. Because if he start retail business, that becomes the competitor for Mukesh. So the deal was he should not start any kind of retail activity for next 15 years. So he can start in 2036. In 2036, he can start any kind of retail business, but he should continue with his existing business called, he's into textile business. So he should continue with the textile business. He should not start any kind of retail activity in the next 15 years. So that is a deal between Mukesh and Kishore Biyani. Okay, so he could not pay its debt. So it is valued based on this method. It is based on this method. So they could, the appraiser calculated the value of the entire business, the entire value, and then it has been sold. Okay. So, we'll go for the case study. It is there in the LMS. You can download, or I'll share the screen now. Anything anybody wanted to clarify? Anything anybody wanted to ask? Anybody? Anybody wanted to ask? Anybody want to clarify anything? Well, if you can see this corporate valuation, Very good. Expenditure on fixed asset. Where is it recorded? Where is it recorded? Where is it recorded? Balance sheet, profit and loss account?
Profit and loss.
Huh?
Balance sheet, sir.
No. Balance sheet. Who said profit and loss account? We should get -1 to her. Okay. So if you do not know, don't say wrong answers. Yeah. So capital expenditure. You can say wrong answer, no problem. But this kind of answers is not expected. We are in MBA Finance, MBA finished all that. It is recorded in capital expenditure means asset. The investment made in assets, which is recorded in balance sheet, assets and the balance sheet. Depreciation and amortization, 266 crore. So what is the difference between these two? Depreciation and amortization. What is the difference between these two? Anybody?
For fixed assets and amortization. Sorry, depreciation for tangible assets and amortization for intangible.
Oh, very good. Who is that? Who is that? Merlin. What's the number? 1 mark.
Merlin Matthew.
Merlin, what's the
19 MG 5010.
19 MG
501023.
5010
501023.
501023. 1 mark. 2 3. It's the first time now you're getting marks?
Yes, sir.
Okay, very good. Any class representative is here? Class representative? Anybody is here? Section A or Section B, Section C, anybody class representative is here? Nobody is there?
Yes, sir. Yes, sir. Yes, sir.
Who is there?
Raghavi, sir. Section C.
Section C. Raghavi, I'll send you the details. The student details, I'll send it to you. You kindly keep an Excel sheet, and whoever is getting the mark, you please enter that particular time. Okay? The previously whoever got, I'll send it to you. Okay? So kindly make a sheet, Excel sheet, and maintain that. Okay? So today, please make note of it. Gayatri got 1 mark. Merlin got 1 mark. Okay? I'll send you the student list. Kindly maintain that. Okay?
Okay, sir.
Good. So, Merlin got 1 mark. So, working capital as a percentage of revenue 20%. Working capital as a percentage of revenue 20%. Working capital is 20% of the revenue. So, 20% revenue means 280 crore. Tax rate 30% for all the time to come. Input for the high growth period, where the first stage is growing. So length of the growth period is 4 years. As it was mentioned earlier, the length of the growth period is 4 years. 4 years it is growing. The growth rate in revenue, depreciation, EBIT and capital expenditure is 25%. It's growing at 25%. Every year it is growing at 25%. Growth in revenue. So when the revenue is growing at the rate of 25%, your assets should also grow at 25%. So, you should keep in mind, the growth in revenue should commensurate with growth rate in assets. In other words, growth rate in assets should also commensurate with growth rate in revenue. What does it mean? I repeat, growth rate in expenditure. Growth in expenditure should commensurate with growth in assets. What does it mean? Anybody? Should I repeat the sentence again? Growth in assets should commensurate with growth in expenditure. What does it mean?
Sir, I'm not sure, but this asset should be used for the purpose of a company. So continuous expenditures should also take place. It should be utilized in a proper manner. These assets should be utilized in a proper manner.
Okay.
For that, regular expenses should also be good. I'm not sure.
Okay. So here what is given is growth rate in revenue, depreciation, EBIT and capital expenditure 25%. Why should the revenue is growing at 25%? Why should capital expenditure also should grow at 25%? Anybody? When the revenue is growing at 25%, your profit should also grow at 25%. the profit also should grow at 25% because the revenue is grown by 25%, the profit is also grown by 25%. We understand. My question is, why when the asset is, when the expenditure is grown by 25, the revenue is growing by 25%, why asset should also grow at 25%?
Sir, usually the revenue increases according to the production sales. So in order to increase the production sales, we have to make respective growth in the infrastructure too.
Oh, very good. Very good, very good, very good. Very good, father. Very good, very good. So father is given 1 mark. Father? Yeah, Father Ebin is given 1 mark.
Yes, sir. Yes, sir.
Okay, so he has put rightly. So when your revenue is grown by 25%, in accordance with the growth rate in revenue, your asset should also grow at 25%. Then only you should create those facilities, not only infrastructure facilities, you should have required assets for creating that revenue, to enhance its revenue. That's what I said. Growth rate in revenue should commensurate with growth rate in assets. So growth in revenue should commensurate with growth in assets. In other words, in either way too. Okay. So when the revenue is grown by 25%, capital expenditure should also grow by 25%. Working capital as a percentage of revenue, it's already given 20%. Cost of debt, it is 10% pre-tax, because it must be post-tax. It is pre-tax. Post-tax we need to calculate. Debt equity ratio is 1:0. What does it mean? Anybody? Debt equity ratio 1:0. What does it mean?
It is having more debt,
No equity. Equity is 0, debt is 100%. Debt is 100%, equity is 0. So the entire money is taken from debt, no equity. Risk-free rate is 7.4%. Risk-free rate is 7.4%. Market risk premium 6%. As it was mentioned earlier, market risk premium is the difference between market return and risk-free return. The difference between market return and risk-free return, that is RM minus RF. RM minus RF is called market risk premium. That is 6%. Equity beta is 1.2667. That is beta of the stock. 1.2667. So what is called beta? Anybody? Beta? Anybody? Hello. Most of you have done the project. What is that?
systematic risk.
Systematic risk. Okay. So is it a highly risky stock or low risky stock?
It is highly risky.
It's not highly risky because it is close to 1. It's not a highly risky, it's a close to 1, 1.2 only. So highly risky must mean it must be more than 2 or more than 3. Then we can say it's a highly risky stock. It's a moderate risky stock. That is a 1.2667. Okay. Then input for the transition period, that's next period. The length of the transition period is 3 years. 3 years. Transition period is 3 years. Okay. Then the length of the transition period is 3 years. Okay, 1 minute. This is the 3-stage model. So I want to give you a 2-stage model. Okay, 2-stage model is not given. 1 minute. Answer is also given. Okay. Okay, it is a, I mean, all the case studies are based on 3-stage model. It's not a 2-stage model. All are a 3-stage model. Okay. Okay, no problem. That we will take up the 2-stage model. Let us calculate the cost of debt, and then we will take up the 2-stage model later, a 3-stage model later. This is what it is. What a 3-stage model. It's not a 2-stage model. The transition period is given and stable growth period is given. So So let us look at this particular case study. We will take it up later because it's a 3-stage model. It's not a 2-stage model, and all the case studies are 3-stage model. So let us look at how to calculate the cost of equity here, cost of equity or cost of debt. Let us calculate, and then we will see. The debt equity ratio is 1:0. So how do we get the cost of debt? The cost of debt is pre-tax is how much? Cost of debt is 10%. Cost of debt is 10%. Okay. So the tax rate is 30%. Tax rate is 30%. Tax rate is 30%. So 10%, 10 into KD is 10%, that is pre-tax. KD is 10%, that is pre-tax. So we need to get the post-tax. So KD post-tax is 10% into 1 minus 0.3. What do you get? 1 minus 0.3? How do we get 10% into 1 minus 0.3? How do we get that? Hello? Anybody? How do we get 1 minus 0.3? Hello? How do I get 1 minus 0.3? What is that? The tax rate is given. The case study itself, tax rate is given, that is 30%. Tax rate is given to 30%. So 1 minus 0.3. 1 minus 0.3, that is given. Okay. So 10 into 1 minus 0.3, that is 10 into 0.7. That is 0.7, that is 7%. Is it all of you understood? Post-tax?
Yes, sir.
Post-tax, all of you understood? 10% into 1 minus 0.3, that is 0.7. So 0.7 into 10, so 7%. Okay, so KD post-tax is 7%. Now, it is given already in the case, the cost of equity is 0. I mean, that's the debt weight of equity is 0. So calculate the cost of equity. KE, please calculate. KE, please calculate. That is RF plus beta into RM minus RF. KE is equal to RF. RF means risk-free rate of return. Risk-free rate of return. All of you have done the case, project on, most of you have done project on beta or risk-free return, all that you have calculated. Risk-free return is rate of return on the treasury bills. The rate of return on treasury bills. That is the government securities. The securities issued by the RBI on behalf of the central government. So it is the 184-day treasury bills. So risk-free rate of return, what is given here is, how much is given? One risk-free rate of return? It is 7.4%. 7.4% is the risk-free rate of return. Market risk premium is 6%. That is RM minus RF. There is a difference between market return and risk-free return is 6%. That is 7.4%. 7.4% into beta. Beta is 1.2667. 1.2667 into RM minus RF. RM is not given. So RM is not given. So we are given RM minus RF. So what should be RM? Anybody? What should be the RM? Anyone? What should be the RM? 7.4 is risk-free rate of return. RM minus RF is 6%. So what should be RM?
13.4.
13.4. Very good. So 13.4, that is 6%. 6% is RM minus RF. So 7.4 plus 1.2667 into 6. 1.2667 into 6. How much comes? 1.2667 into 6. How much comes? Anybody can calculate?
7.002.
How much? 6 point?
7.6002.
7.6002. So add both. 7.4 plus 7.6002. How much comes? How much comes? Add both. That is
15.00, sir.
15 point
00.
15.00, correct?
Yes, sir.
So 15%. So 15%. So 15% is the cost of equity. Cost of equity is 15%. So get the weighted average cost of capital, that is KD into WD. WCC is equal to KD into WD plus KE into WE. So KD is 7%. So 7% into 1. 7% into 1 because debt equity ratio is 1 is to 0. Okay? So 1 into 1 plus KE is 15% into 0. So WCC is 7%. WCC is 7%. So any clarification, anybody? To calculate weighted average cost of capital. Any clarification, anybody? Because very important before we calculate the cash flow. Before we calculate the cash flow, it is very important